Everyone, welcome back to another webinar Wednesday. We're live here today talking about multi-unit residential real estate, and if you want to get a part of it, how do you get the financing and stuff like that. So a little bit about who I am. I'm Sheehan Patel. I'm part of the Patel Wealth Management Group. It was started in 1981 by my father, Shik Patel, who's still in the business today. And our business has gone really from that stock brokerage business into this fully wealth management business where we don't do just stocks and bonds, but we do everything that has a dollar sign attached to it except for accounting. A little bit about me. I joined the business in 2014. I am the associate investment advisor on the group, and my responsibilities are more of coordinating the wealth management side of the business and using all the different partners that we have. So today I'm really proud to announce that we have Philippe Bertrand here to talk about multi-unit residential financing. Today is a purely strictly educational call, and I hope you all learned something. So over to you, Phil.
Thanks, Gene. Thanks for inviting me to your broadcast. Very glad to be here today. A bit about myself, been with the bank for 13 years, always been on the real estate side. Most of what I did at the beginning was construction for the first 5 years, and after that started to do multi-res financing. And I've been doing it for the past 8 years or so. Started in Ontario and covering now from Ottawa to Vancouver for anything that is multi-res financing. National Bank has a specific department where we only do apartment financing. So we're not actually having people that are actually cover different types of assets. We have people that are specific to this type of assets, which makes a big difference whenever it comes to transaction.
So your bread and butter is just apartment buildings, eh?
Exactly. So it's the only thing we do from morning to night.
That's fantastic. So I guess you said you were doing these transactions at the bank for the last so many years. What did you do before that?
Work for the bank, but work for the bank on the construction side, doing some financing on for builders, for houses, condos, semi-detached, row house, and all types of assets that were actually being built. I was more on construction. Some of those clients were actually doing also some multi-res financing. Like we were actually doing the construction on it, but left that sector just to do the multi-res. And on the multi-res, just a small point on that is we can also do the construction. So based on the fact that I did construction for the first 5 years at the bank, I still have the knowledge to actually bring that up to the multi-res department and cover this aspect also.
So Phil, what does it mean, multi-unit residential? What does that mean?
Multi-res department actually covers financing on any buildings with more than 5 residential units. So at the bank, we've got 2 sectors. We've got the sector which is called residential. They cover the financing for 1 to 4 unit properties. So any duplex, triplex, fourplex, and houses will be done at the branch level. Whenever we talk about the 5 units or more, this is what we call the multi-res department that covers these types of assets. So we can also look at mixed-use properties, which is bottom floor, let's say commercial, and the above floors being residential units.
That's another separate person, right?
Pardon?
That's a separate person?
No, it's also myself that would actually be looking at those transactions.
Okay, cool. All right, so Phil, why don't you tell us and our viewers a little bit about what the bank's view and what your view is on the multi-unit residential real estate, and maybe touch on a little bit about what it was like prior to COVID-19 and actually going on today.
Yeah, very good question. Actually, there's a lot that did change over the past few months. I think every lender did actually adjust to the new reality. Some pulled out on the market, some actually increased volumes, some came back to actually with different types of products and so on. For National Bank, the big difference is we actually decided to put more pressure on multi-res financing than other type of assets. Everybody needs a place to live, so it's less risky at a certain point than commercial properties. So we're doing a lot of financing on multi-res financing, and the fact that, we cover a large territory anywhere in Canada. We try to focus on larger size cities where there's less risk if we're actually financing downtown Toronto, downtown Hamilton, than smaller size cities where we've got 2,000 or 3,000 people. And there's a bit more risk. So the bank did adjust on that side. And the other big changes that the bank did is we're doing more CMHC insured financing than conventional financing. And the reason behind this is because we're insured with the insurance of CMHC. So there's less risk for the bank.
So, Phil, just quickly, what's CMHC for those that don't know?
CMHC actually insures the mortgage. It's a federal agency at the government, and they insure the loans that we're doing. So it comes with different types of additional costs. There's premium, there's costs involved on each transaction, but there's benefits for clients. The rates that the bank are able to give, because the loans are insured, is lower. There's a gap probably on a 5-year rate, just to give you an example, probably between 1% to 80 points. So it's huge when you think about it. And the reason behind this is because all banks is the same thing. They don't have to put money aside to cover the risk because it's insured.
Got it. So I guess, why don't you talk a little bit about, because I know there's a couple mortgage brokers online and some real estate investors. Maybe you talk about, if you want to get into this multi-unit area, how do we kind of do it, or how does an investor do it? Obviously, the lending guidelines are different for 1 to 4 units versus 5 units and above. So if you could talk a little bit about that.
Well, I think anybody that wants to actually join multi-res financing and wants to buy some properties, if they're new to it, big points that are important to do is either to find a commercial broker that actually covers these types of assets. And there's very good brokers on the financing side that can help also on those. We do at National Bank work with a lot of brokers, and in some case, clients will actually find the property, work with the real estate agent, go with a broker for the financing, and a broker will come to the bank to finalize the transaction with a lender. So I think for anybody that actually wants to step in that game, to find a real estate agent that actually knows these types of assets is one of the most important thing. And after that, to find a partner for the financing, either directly with the bank or in some case with a broker that will actually convert this with a bank on the debt side.
Thanks, Phil. It's actually, I like how you said, it's really important to partner with good people, especially a real estate agent, and on the other side, a mortgage broker. But the beauty of working with us and our team is we actually are the bank in some way, shape, or form. Phil works with me. So by working with Phil, you can save yourself a little bit of costs, but we won't talk about that today. It's just, there's mortgage brokerage fees and all that. So I guess when it comes to the multi-unit residential world, those types of, what are the competitive advantages of working with the National Bank of Canada on those transactions versus other institutions, and try to not say any other institutions' names?
Yeah, well, I think one big aspect is we have a group, as I mentioned at the beginning, that actually only do these types of assets. Sorry guys, I'm not sure I see here that the screen is cutting a bit. Am I right? Okay, everything's fine.
You're okay.
Yeah, so we actually only cover these types of assets. So we do this from morning to night. We know exactly what we're doing, so the speed process is fast. And we try to put everything in place with the best possibilities for the client. So whenever a client calls us and says, well, I'm looking to purchase a property, we'll come back to him and we'll say, okay, well, depending on the asset that you're looking to buy, we'll give you options. It might be better to take a shorter term on one transaction than a fixed 5-year term, because the person behind the transaction might want to actually increase rents and refinance down the road. So we'll have different options for the client, either conventional financing, CMHC insured again, or different terms. We can actually offer 1 to 10-year terms, which is a variety of different terms that are available in the market. We have variable rates also, and as I mentioned, we do this from morning to night. So every month we do tons of transaction. And another big part of that is we have a book that are actually people that are selling property. So a client that actually comes to the bank and says, okay, well, I'm looking for this type of asset. Well, we might have that asset that is in our books and the client is willing to sell it. So we do work a lot of transaction with clients that are buying and clients that are selling directly from the book. So there's a relationship that is actually very important for us that we built over years, and clients stick with us and just keep adding assets to their book with the bank.
That's awesome. So you can actually connect people on both sides of the transaction. I think that's a huge benefit, to be completely honest with you. I wanted to talk about one thing there. You were talking about years of amortization, I believe. How much do we have to put down if I want to buy a building? How much am I putting down? Does it depend on various things? And then you also touched on the build and renovate and stuff type of strategy. Let's just touch on that a little bit and how the bank works with people with those types of strategies.
Well, first, conventional CMHC insured financing are two different types of financing. So if I start with conventional financing for any properties of 5 units or more, amortization will be 25 years. We can actually do shorter amortization period if the client wants it, but we cannot increase more than 25 years. When it goes to conventional financing, we've got different terms: 1 to 5 year, 7 year, and 10-year term. That's probably the product that we use whenever a client is actually buying a property that needs renovation and will actually be over time stabilized, and there's an exit strategy that will be put in place. So let's say a client buy an asset and he needs 2 years period to actually do renovation, increase rents and things like this. We will start with conventional financing on a 2-year or 3-year term. And after that, if the client wants, we can actually move the transaction on a refinancing with CMHC to get, as you mentioned, a longer amortization once the property is stabilized. So with CMHC, we can actually offer 25-year amortization, 30-year, 35-year, and even 40 years on new build. So it's not only on new build, we can actually do it when the transaction is very strong, 40-year amortization with CMHC, but it's a big difference whenever we're actually doing the calculation of what could be done in terms of financing based on cash flow when we actually run the numbers with 40-year amortization compared to 25 years. There's a big point in here is all transactions are finance based on the cash flow of the subject property. We're not financing the person behind the transaction. We are really financing the property itself, which is different from the residential financing.
Yeah, it's on the cash flow, not the actual building.
Exactly.
So if the actual cash flow of the building, the apartments are generating X amount of return and the building's worth Y, then it's actually more based on X, is that or the cash flow, is that correct?
Correct, exactly. So we can finance up to 75% on conventional or up to 85% on CMHC insured financing. But that being said, we're financing the cash flow. So sometimes we'll have to lower the financing to respect what we call a debt ratio, which is revenues over expenses.
Got it. Oh, thanks, Bill. I really, that's a great answer there. Let's just talk a little bit about the volumes of multi-unit residential transactions that you've been seeing since pre-COVID-19 versus post-COVID-19. And where are those transactions happening? Are you seeing a lot more in dense residential areas? Are you seeing more outside of that? A little bit about what you've seen.
Funny to say, but there's a few lenders that pulled out of the market during COVID, so that actually brought us a lot of transaction. A lot of brokers that actually do these types of financing actually go directly to CMHC to get their certificate. So whenever you submit a file to CMHC, the bank or a broker will actually go and get a certificate for the property. That certificate can be actually sent to a bank to get a financing. So there's a lot of brokers that actually have those certificate in hand and actually are shopping those to get the best rate and the best conditions for the clients, which is perfect. So we got a lot of certificate that were actually transferred to National Bank after the COVID started. Because it was all shaky and it was lenders that were not sure what was the next move to do and things like this. So I would say that after, March, April, May, we started to see more and more volume, and it's still the same thing at the present time. There's a lot of transaction going on multi-res, and we have to think about something. It's probably one of the real estate sector with the less risk at the present time. Everybody needs a place to live. Everybody needs a place to sleep. And I think there's tons of good properties and business to do on these types of assets at the present time.
Yeah, where are you seeing those properties? Are you seeing it a lot in Toronto? Are you seeing a lot in Hamilton? Or what about like areas like I don't know, more rural areas?
Yeah.
Where are you seeing?
At the present time in the books, we've been doing a lot of transaction in London, Hamilton, Windsor, Toronto, Ottawa, and lots of transaction in Calgary, Winnipeg, Vancouver, and Edmonton. Those are the most cities where we actually did some transaction lately.
That's super good to hear that Hamilton's a healthy market for multi-unit residential. Obviously, I'm a Hamilton guy. Again, a lot of you on the call might actually might have some questions. If you do, there's a little button just there. Just click it and ask them, and I'll ask Phil out loud. Again, this call is very high level, so some of you that may be on it may not understand what he's saying, and then there's also those that are on here right now that probably know way more than what he's saying. So if you have any questions at all, feel free to call me at 905-849-3549 or send me an email at sheehan.patella@nbc.ca, and I will connect you with Phil. Phil's been working with our clients and trying to educate them and make them better real estate investors. And at the end of the day, we want our clients and everyone that we work with to be more wealthy. That's kind of what our idea is. So I think I don't really have much else to add here. I'm going to leave the line open. Was there anything you wanted to touch on in the multi-unit residential space there, Phil?
Well, maybe one point that I could actually discuss is what are the difference between conventional rate and CMHC insured. As I mentioned earlier on the call, there is additional fees to go with an insured mortgage and premium, but there's advantage on the rate side. And just to give you an example, our rate are actually based on cost of fund. So cost of fund do change daily. So cost of rates will change daily. But
what does that mean?
Today,
what does cost of funds rate mean? Just before.
Cost of fund is the treasury that comes out every morning with a cost for the bank to lend money.
Got it.
This being said, every morning they'll send us a grid with different terms, 1, 2, 3, 4, 5-year terms, 7-year and 10-year. And that grid, we can actually price deals based on this. Based on that, exactly. So to give you an example, 5-year money today would be an average of, let's say, 2.30%, and a CMHC insured might be around 1.50% for the 5-year term. So there's a big gap between both. So even though, CMHC might have fees and premium involved on the transaction, the rate differential is huge. So this is a big part of what we've been seeing at the present time. Rates are super low at the present time. Probably the lowest rate that I've seen in the past 13 years doing this for the bank.
Do you think it can go lower?
Very tough to say. I doubt, because to me, this is almost floor rate.
Yeah.
It's so low, it's very hard to think that this could be lower than this. It's some clients were actually financing more on a transaction before COVID started and rates started to come down than they are now, because rates are so low that they say it's not worth it to keep money in the bank account when rates are at 1.50, 1.60 for CMHC insured mortgages. So
interesting. I have a question from somebody anonymously, and I'm not really sure exactly what the person said, but it says, how long should, I guess, the conditions for a 5-plex with CMHC insured mortgages be? I think that's what the person meant to say.
Yeah, that's a very good question, actually, because CMHC, it's the same thing for all lenders. So whenever we send a file, we built a file at the bank, we send it to CMHC to get the certificate, there's a time frame that is actually not controlled by the lender sending a transaction to CMHC. At the present time, CMHC time frame 8 to 12 weeks before we get the certificate. 3 months ago, it was probably 4 to 8 weeks. So it's the gap is being a bit more at the present time. I think it's going to be solved in the following month or so, because with all the vacation of summer, probably CMHC, they've seen a lot more volume, but they also had those vacation for summer, which is normal. So probably they'll catch up on that gap, and they'll go down to 4 to 8 weeks in the following months. But at the present time, I would say 8 to 12 months, 8 to 12 weeks.
Got it. Hopefully that answered your question out there. I personally don't have many other questions to ask you, Phil. Let's just, do you think there's anything that, if you're a mortgage broker and you're on the line, that they should know before they send deals to you? And again, if you need to send deals to Phil and I haven't introduced you already, feel free to get a hold of me and I can make the connection. So Phil.
Actually, the only thing that we need to establish what could be done in terms of financing when we look at a transaction is the cash flow of the property. So if we get a bit of information on the property itself and a statement where we see the revenues and the expenses, we can actually reply to the email with some possibilities in terms of financing. So within a few minutes, I could say we will be back to the broker or the client and give him options. And after that, based on what he thinks the client would prefer, or if the client what he prefers, we will actually send a discussion paper with all the conditions and so on. So we don't need a full package on day one. We only need information on the property itself, because we're financing at the end of the day the property. We will be asking more information afterwards, but I think, for any people that want to actually see if a property is worth it, we will be more than happy to run the numbers for them and see what options would be the best.
So there you go, everyone that's on the line. If you want to buy a property, get the cash flow, the revenues and expenses, and all you need to do is send them over to Phil. Phil will figure out how much you need to put down, what your interest rates were going to be, if it should be conventional or CMHC, how long it should be. He knows all of this. He's your expert, and use him as you can. I think that the multi-unit residential industry is exploding here in southwestern Ontario. We just see everyone's basically talking about it now, and I think it's super important that we as a wealth management company partner with people like Phil, so that our clients can participate as well. So yeah, I really appreciate what you have done here today for us, Phil. Thank you very much. I don't believe we have any other questions that are coming in. So again, if anyone does have them, feel free to give me a call, 905-849-3549, or email me at sheehan.patel@nbc.ca, and we will connect you with Phil, and you can have that conversation. Thank you very much, Phil. It was a pleasure talking today.
Thanks to you. Thanks for the time, and I hope I did actually give a bit of clarity to some of the people online. And as Sheen said, if you do have any questions, feel free anytime. Any questions are good, and I'll be more than happy to see what we can do.
All right. Thanks, Phil. I appreciate it. Have a good day.
Thanks.
Take care.
Okay, bye.
Bye.